Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today, we are diving into Amazon's latest quarterly report. Will it be a tale of continued e-commerce dominance, or are there storm clouds on the horizon? Let's find out. This is the filing for the first quarter of 2025, so we will get a glimpse of how the company performed in the first 3 months of the year. As usual, we're going to focus on financials and notable items to see the overall health of the company and what their executives think about the next few months. Let's start with a quick look at their cash flow. The company started the quarter with over $82 billion in cash equivalents, and restricted cash. That's a lot of money in the bank. During the first 3 months of 2025, Amazon had a net income of over $17 billion. That's quite a bit of money earned in a short amount of time. Compare that to the same period last year of roughly $10 billion, and you can see their profit has gone up a lot. However, they also spent around $25 billion in property and equipment. So what are they buying? We will find that out later as we read on, but it means they are investing a lot in long-term tangible resources like buildings or vehicles. They are also really active in the market, selling almost $8 billion in securities and buying over $13 billion. They did not get into any significant debt compared to last year, but we do see they continue to pay for long-term financial obligations. After all of that, what did they end up with? Almost $70 billion. That's more than enough to buy Twitter many times over. The diluted earnings per share, which is a measure of profit per share, came out to $1.59 compared to $0.98 from last year. That's a good sign. Let's dig into how they made their revenue. They have almost $64 billion in net product sales, which is sales from actual goods. They also earned close to $92 billion from services, meaning things like AWS, subscription, and other revenue streams that are not tangible goods. Cost of sales, this is the cost of producing the actual goods sold or providing those services. It's over $76 billion. Compare that to $92 billion in service sales, and that gives you the gross profit that they are making. Fulfillment costs, or the cost of shipping, handling, and other things of the like, reached almost $25 billion, making up a large portion of their operating expenses. Spending for technology and infrastructure is at almost $23 billion, another major operating expense for the company. General and administrative costs seem to be relatively stable at around $2.6 billion. These are important to keep an eye on as they can be indicators of major problems in management, but for now it's standard. The company earned just over $1 billion in interest income. With such a large amount of cash in the bank, these safe investments net a sizable reward with virtually no risk. The interest expense or debt payments were relatively low at around $541 million. Lastly, something interesting, other income is around $2.7 billion. Let's go deeper into where that comes from. Most of the value in other income expense net comes from how their various investments performed. Foreign currency changes also account for a small change. The rest is made up of other various items. The table shows that other comprehensive income loss demadditive. So what does that mean? Most of this is caused by fluctuations in foreign currency. Depending on the economy and which countries the company operates in, the numbers can vary greatly. The SEC filing has kitten fraction, context ref the 4 decimals, 8 ID method investments, scale 9 unit ref the mine 2 noon, listed as investments accounted for under the equity method of accounting. Investments for which the company has elected the fair value option lets them record changes in fair degree of influence, but not a controlling stake. The fair value option lets them record changes in fair value in current earnings. The company has a lot of funds tied up in the short term, but a significant amount of debt maturing later. Okay, let's see what the company committed to. In total, the debt totals almost $90 billion over the coming years. This is not particularly concerning. They also have almost that same amount roughly to pay for leased property and such. This is a major thing to consider. All right, here's where things get interesting. What are they getting sued for? The company highlights the lawsuit with the CNPD regarding user data and privacy in Europe. However, Amazon has appealed this. Here are also some things we learned from the earlier sections. We know that Amazon is a large accelerated filler and they are not a shell company. These are 2 fairly common disclosures you will see in almost every report, so I won't deep dive here. So after a very high level view, it looks like Amazon had a successful quarter, but what can we learn from that? From a higher point of view, it's evident Amazon has a strong grip on its North American market. The increase in sales and operating income in that region is solid, showing continued customer engagement. Amazon is keeping those customers and is making a lot of money doing so. The international segment has its challenges with a slower growth rate and the impact of foreign exchange rates. Eating into potential gains, the company is performing very standard for what is expected and shows they are healthy overall. W's is a shining star with consistent growth in sales and operating income, proving its dominance in the cloud services market. This segment really carries the operating income for the whole company, and it shows that they should continue to invest in that department. However, keep in mind that operating expenses, particularly fulfillment, technology, and infrastructure, are substantial and increasing. While these investments are necessary, they need to be managed carefully to maintain profitability. The reclassification adjustment for the Anthropic investment really boosted their books and may not be sustainable in the future. Of course, their long-term financial obligations are still very high and should be kept an eye on. Finally, legal battles, especially in Europe, continue to be a risk, potentially leading to significant costs or changes in business practices. Overall, Amazon shows great financials and is expected to grow in the upcoming months. That's it for this episode of Corporate Decoder. If you found this breakdown insightful, don't forget to like, comment, and subscribe for more deep dives into the world of corporate finance.